Welcome everybody again. We'll progress forward with the slides. There is a standard disclaimer slide next, and then moving on to our introduction and highlights, which are these. So we had very nice growth in all markets, excluding China, 16% growth, driven with the highlights in Latin America, Brazil and Mexico, high performers there, and in South and Southeast Asia, Thailand and India being the standout performers, poultry market in India being a nice drive for us, and the swine market in Thailand. What happened in China? Well, it's well documented that there's been a few years ago a pig pandemic of African swine fever that led to a decimation of the herd, then a huge overswing of repopulation, which led to a glut of product in the marketplace. And that led to relatively low pork prices. And that was true coming into this period. And at the beginning of this period and through part of it, the producer margins were negative. However, now, since beginning of May, end of April, we've seen the pig price begin to recover, and now at a stage right now of decent pricing and good profitability for the producers. So it's a story of recovering prices during this period. But in general, the market was unfavorable to us in China, and we were suffering headwinds. That does look better for the future, but was a headwind for this period we're reporting. On the other side of our business, the future side, R&D continues to deliver. We are moving our R&D pipeline forward on track. We expect our first approvals coming by the end of next financial year. We should have 2 approvals by the end of next financial year. And as our pipeline begins to mature, we are also filling our pipeline. And this period, we announced 2 new collaborations with globally recognized research institutes. One, Imperial College of London, where we picked up the license to explore on the veterinary side an mRNA platform. This is similar to the human vaccines that helped us with the human coronavirus vaccines. And we have the opportunity to look at this platform to produce veterinary vaccines. Interestingly, AstraZeneca picked up the same technology from Imperial College for use in humans. So I think that gives you an idea of how interesting that technology is. And from Moredun, which is a research institute outside of Edinburgh, very well recognized in animal health, we've picked up the opportunity to look at a particular poultry product for a opportunity into red mites, which is a globally important disease for poultry that impacts the health and welfare of birds worldwide. And there are no vaccines around at the moment for that, just some chemical treatments, and they have their own limitations. So in the long term, that looks like an interesting opportunity, which we are researching right now. We'll move on to the next slide, which brings us through some financial highlights, and I'll pass over to Chris Wilks, our CFO, to take you through the financial highlights.
Thank you, David. Thank you, Hannah. So the financial highlights, just dragging some of these out of the release. Headline sales did show a decline, 9% year on year, and here we're comparing the first half of 2021 against the first half of 2022. That 9% decrease. We'll speak a lot about China, I'm afraid, but that really was the causative factor around that decrease. Separating out China, and Japan happens to be lumped in with China, but I think we've said before, Japan, in fact, is only about £2 million revenue. So the lion's share of that is China. So separating that out, we can see this sort of nice 16% growth, which David mentioned earlier on. And I think that's something which we make no apologies for mentioning a couple of times during this presentation. The other strong result this period was consistent margins, consistent at 45%. And I think any business which is showing consistency in gross margins during this sort of period of inflation or emerging inflation is actually a business which is controlling its costs well, and also reflecting any cost increases into sales price increases. So we'll speak more about that later on, but that, I think, is another strong result this period. EBITDA was slightly off compared to the prior period. as a direct result of revenue reduction, which I mentioned earlier on, driven by China. Next slide, please, Hannah. So some of the other features of the financials, cash overheads did increase, and cash overheads, by that we mean the admin expenses excluding R&D, which we deal with separately, FX, and those sort of non-cash based expenses like amortization, depreciation. So that element of cost was £0.8 million higher. The primary driver in that was the return to travel post-COVID. Important to get in front of our customers. There's only so much you can do with Zoom and with Teams and webinars and so forth, and it has served us extremely well throughout this period. But it's very important to get back in front of clients. The sales process for Avalesin, for the company's products, is very much a technical sale. It's describing the advantages, technical and efficiency-wise, of using the group's products. So it's an important face-to-face process. Earnings were strongly increased compared to the prior period. We reported a loss per share in 2021 compared with a profit per share of 1.96p this period. A primary contributor to that was an FX gain, which you'll see on the face of the P&L, benefiting really from the weakness of sterling in our export markets. New product development, we increased our expenditure there 5%, and that's cash-based expenditure, £4.2 million. We break that out later on as between the charge and the P&L and the amount capitalized. And cash on the balance sheet, this is £8.9 million, excluding a pro forma adjustment for the cash held in the joint venture in China. Just for presentation purposes, it gives you an idea of what cash the group has direct access to in its entirety, rather than being shared through some sort of joint venture arrangement. So going into the first of two slides, which describe the revenues in a little bit more detail. The first thing to notice when you look at the top two charts is the pattern. And the pattern over these 4.5 years, which we present here, definitely is mirrored in the pattern of revenue from China. So you can see the importance of China. You can see how the peak in revenue in 2021 in China benefited the overall group position. And looking at that top right chart for China, you can see the pattern of the revenue in that segment through the course of the last 4.5 years, which was really dominated by the structural change arising from the outbreak of African swine fever in late 2018 going into 2019, when we had a relatively normal year in 2019. Then we had destocking, a recovery period in 2021 when the producers were restocking as fast as they possibly could. That resulted in a bit of an overshoot, and the fall off in the pork price we've seen in the last year, and back to where we are today with a low revenue of £8.5 million in the 6 months, which is only the only period lower than the last 6 months has been that first 6 months of 2020, which is when the herds were being culled as a result of the outbreak of ASF. As David mentioned earlier on, all the indicators look positive in China around pork price, and particularly around the ratio of pork price to grain price, which is a primary indicator of farm profits. And it's when those farm profits turn positive, that's the opportunity which turns positive for the sale of Avalesin, and we see that right now. So putting aside China for a moment, at the bottom left chart, you can see the sort of consistency of performance that we've achieved And in fact, if you go further left off the chart, going back into history, this business has seen the sort of low double-digit growth in its worldwide markets on an annual basis. So that's something which we are very pleased with, and it shows how Avison as a brand is performing on the worldwide stage. And I think all of that is probably put together best when you look at the line charts. The blue line, which represents those rest of world markets, the zigzag is the second half weighting compared to the first half weighting. You'll see that in the bars, but you see the upward trend in performance, and I think that's something which we would point to and indicate as an ongoing trend within this business. If we move on to the next slide now, Hannah, you can see where we have undertaken our business in the last 6 months, and in the quadrant, in the pie chart, you can see the quadrants, the 4 key quadrants there in the main markets. So China and Japan, North America, South and Southeast Asia, and Latin America, each representing between sort of 19% and a quarter of the business, which gives us an indication of good spread of business. It's moving away from an extreme dependence on any particular geography. And I think the bar charts on the top right really give you that sort of sense of the areas where we really are growing quite rapidly. North America, South and Southeast Asia, and David mentioned India and Thailand earlier on, and Latin America. And in fact, in that South and Southeast Asia geography, you can see the rate of growth. So in 6 months ended September 22, we have achieved almost as much revenue as we did in 12 months ended March 19. So it gives you an indication of the rapid growth in that area. This business, if you've studied it previously, you'll have seen and identified that second half weighting, which we seem to see in this business every year. Historically, and if you go back 12 years, I've plotted it. We average around 45 first half, 55% second half. Clearly, a second half weighting will tend to be exhibited in a growth business. But there's actually a structural reason for that second half weighting, and that's around disease prevalence. Disease, it tends to be more present in the winter months, particularly the kind of diseases that Avison treats. And the winter months in the Northern Hemisphere fall into our second half, hence the reason for the second half driver. The particular weighting tends to be more about the impact of China than anything else. And so in March 20 and March 21, these were periods when China had a big second half impact. And as we look through to March 23, because all the macros are turning positive, we see a much stronger second half from China. That should give us a group position where we have a more weighted second half, so more likely to be a 60% second half than the 55% we've seen on average in the past. So moving on to the next slide now, Hannah, R&D expenditure, a very simple chart showing what we spent in cash terms in each of the last 4.5 years. And the key takeaway from this is a descriptor of the evolution of our R&D activity. So in March 19, we were still doing quite a bit of R&D in Avison and developing different label claims for Avison. And so you can see that the amount capitalized, the amount in gold there, was largely represented by Avison activity. That reduced to 2021, where pretty much we had explored all of the areas open to Avison in terms of new activity, in terms of new label claims, and we were moving into the vaccine activity, and in particular the two leading projects, which are the vaccines for poultry, they entered the final phase of development, which attracts capitalization treatment in the accounts. Hence, you see the increase in capitalization in 22, and then in 6 months, ended September, we've capitalized almost as much as the whole of last year. So that's an indication of the evolution of the R&D activity. Next slide, please, Hannah. In admin expenses, not a great deal to say here. I mentioned earlier on that 0.8 million was the increase in admin expenses from September 21 to September 22, largely driven by travel, and that's really the underlying story in this chart. Moving on to the next slide, this is just a graphical representation of the bridging between the EBITDA that we reported in September 21 of 3.4 million and the 1.7 million we reported this period. The main moving part was revenue. Eco is a revenue-driven business, it's largely fixed overheads. So clearly the fall off in China revenue during the period was the largest impact on this chart. I said earlier on that the gross margins were consistent at 45%. In fact, if you go to 1 decimal point of rounding, you see that there's actually a 0.8% increase in gross margin. And so that benefited us in profit terms, offset by the increased admin expenses, travel I mentioned earlier on. And then R&D, we increased our cash expenditure 5%, but equally we increased the capitalization. And so hence the charge to the P&L was reduced by £0.4 million, bridging across to the September 22 EBITDA. Now turning to the balance sheet, and the biggest items on the balance sheet, as ever, are working capital. And we've done a very simple calculation of the average stock days and debtor days. The stock days is quite high, at £32 million of stock holding increased from year end, and represented as stock days, clearly also quite an increase. This is a direct consequence of an excess of stock we're holding in China. Those of you that have studied the accounts and read the reports will recall that we have been going through the process of a new factory build in China. This commenced in the late winter, and we shut down the old factory whilst we developed the new factory. In advance of that, we built stock to cover us through the trading right through to November, this month we're in now. And of course, we were prudent in building stock to ensure that we could cover any demand through that period. We've already spoken about this, the soft trading in China. Clearly, that hasn't drawn down the stock as much as we might have expected, and therefore we're still holding an excess of stock in China. I can tell you that, as reported in the interim statement, we had a very strong month in October in China, and that has continued into November. And therefore that inventory number has continued to decrease after the end of September and through October and November. So pleased to see, and we expect to see that inventory number fall by the time we get to year end. Debtor days, receivables, all very consistent period on period, represented as debtor days. We're sort of averaging out around that sort of 110 to 130 days, which is practically a pretty reasonable number, given the profile of our customers, distributors, and contractual arrangements. It doesn't stop me from trying to drive the business to a better performance, but nevertheless, it's consistent, which is the important thing, and that's then demonstrated by the cash holding position coming through there. Next chart, please, Hannah, thank you. The cash flow statement is very much a mirror image of what you see in the balance sheet. We have the unwind of year-end receivables into cash, which you would expect to see. The China factory I mentioned earlier on, the capitalisation of the costs there in the 6 months, £1.3 million. The rest of it was in last financial period. So what part of that 1.6 is the China factory. And then the capitalisation of R&D relating to the late stage poultry vaccine work, that's also there in the cash flow statement, as you would expect to see that. So we now move on through some other features, and I hand it back to David.
So this is a graphical representation of what we said before. This is a graph of the pork price in China in the past 2 years or so. What you see is in early 2021, there was quite a precipitous sharp slope downwards. And what we've seen consequently in early 2022 or mid 2022 is quite a sharp recovery from the early summer period. So this is supportive of what I said earlier about the recovery of the pork price, which is driven by reduced pig inventories coming through into the marketplace. And that looks nice and stable going forward as well. We would not expect the same precipitous decline as we've seen previously. The pricing, because of the reduction in inventory, looks to be reasonably stable. There is some crimping of demand due to the COVID shutdowns in China, but despite that, this price has increased despite that retail constraint. So the projections for the price going forward, if you extend this chart off to the right, is that those prices should remain in decent profitability for the pig producers, and that therefore is supportive of our business in China. So moving on to the next slide, this is to update you on where we are with our environmental, social and governance credentials and progress. We are progressing mainly on E, and S of these three letters. And we've spent a lot of time on governance over the past couple of years, so we're focusing a little bit on E and S. And for the E, we are looking at our energy audits in our main places of business so that we have a baseline for our energy consumption and then can target reductions from that. For the S, societal component, we looked at our diversity metrics towards the end of last financial year. And that showed that we are extremely diverse business, both by gender, by geography, and a number of other parameters as well. There is some opportunity for improvement in certain parts of the business, but fundamentally we're a nicely diverse business. Also, we've done a peer group benchmarking exercise to see how our peer group in the guise of Elanco, Merck Animal Health, Dechra in the UK, and also AstraZeneca to give us a human biotech comparison. So we've looked at what that peer group is doing, and we've developed out of that a long list of targeted actions that we could do, that we are now focusing on a short list. And that short list will be our list of targeted actions to produce our climate transition plan. And we will put tangible targets against that short list of actions, which will be aligned to the UN Sustainability Development Goals. And we will report on our progress in the next annual report. But I think we're doing very, very nicely here. I just wanted to give a brief update, and we've got the benchmarks, both industry and peer group benchmarks, that will give us further comfort that we are at least as good as our peers, if not better in certain areas. And progressing on to the next chart, I mentioned some of this R&D update already. The first poultry approvals by the end of 2023 is one highlight. Another highlight for our medium-term pipeline is we had some really encouraging and excellent efficacy demonstrated with our medium-term pipeline in the guise of our swine monoclonal antibody program. So that was very, very encouraging, and we look to provide further updates in a capital market update before the end of Q2 next year. What we're doing is we're moving all of our pipeline along. We're moving the short-term pipeline along, which is our poultry approvals, the medium pipeline, which includes the swine monoclonal antibodies. There are others as well, but the swine monoclonal antibody is a big highlight. And our long-term pipeline, we bolstered that by inking 2 research partnerships in this last period, one with Imperial College London and one with Moredun. So great progress with the R&D pipeline across all of the stage gates of that pipeline. Next slide, please. Just to touch on some of the operational improvements that we've concluded this year. Chris mentioned the China production plant. We're very pleased to note that that plant has been completed on time and in budget. We have achieved the major approvals such as the GMP approval, and subsequently to this slide being put together, we have now received the final licensure from the Ministry of Agriculture. That came through on Thursday or Friday of last week. So we are now in a position to commence or recommence production in our new factory there. We've also signed manufacturing agreements for our future pipeline. That's our biological pipeline. We continue with a CMO basis of our production, so contracting out our manufacturing to contract manufacturing organizations. And we now have those deals signed for both the Americas and for Europe and all points east of Europe. So that's very good progress there. We've also been able to increase our prices in most of our markets in the early part of 2022, and other increments are planned for early 2023 to continue to support the gross margin, as Chris mentioned earlier. So that should help to sustain our gross margin in a decent percentage going forward. We have a relatively complicated supply chain, and one of the projects that we identified this half is to try and simplify that. Some additional complications were added to that over the years for history reasons and for some of the Brexit arrangements. We can simplify our supply chain by decreasing the number of partners that we work with. For example, decreasing the number of releasing points that we have for continental Europe and global business, therefore concentrating our business with a certain number of releasing organizations, and that those projects have commenced. And also we've strengthened the team. We've employed this period a new HR director, the first HR employed professional we've had in the business, which is, I think, necessary to drive us forward to the next level. And also we are advanced in the recruitment process to have a biological manufacturing lead that will help us do the technology transfer from late stage R&D into our CMO partners to produce the biological. So it's important we control that, and we've progressed on that front. Next slide, please. So conclusions and outlook. I think the highlight here is we are continuing to deliver on our earnings and delivering on moving our R&D pipeline through there. So very pleased to report that our revenues and profitability are on track and as per our prior guidance. As we've said, China looks to be less volatile in the future. The pricing is now favorable. We've maintained our margins. We've grown our business substantially outside China. That's actually outperformed our expectation in the rest of the world. We believe that the second half of revenues in the rest of the world will continue to deliver reliable growth. And with China in a good market position, we think this is encouraging progress all round. And if you add the encouraging progress of R&D, I think this is a very nice position to be in, and we're very happy to report that. And there's one additional bill that gives if you just click through the quote from our chairman, Dr. Andy Jones. We recently reviewed our strategy. That endorsed our vision, that we are on the right track with our objectives for the revenue side of the business and our investment and R&D side of the business. And the direction looks good. And with cautious optimism, we look forward to reporting full year numbers, absolutely in line with the guidance and market expectation. So that's the formal end of the presentation. Thanks for clicking through that and helping us there, Hannah, and we are open for questions.
Thank you. And we have a number. My understanding is that all the secret sauce worldwide for Avlison is produced in China for export from there to the manufacturing units around the world. Is this understanding correct? So
the API, that's the active pharmaceutical ingredient, is indeed made in China. That is made into final product in various parts of the world. So it's made into final product in China, but also in the UK and in North America. So the active ingredient's made in China, but final product is made in a number of global places.
Thank you. And so following on from this, can this gentleman understand why the decision was made pre-COVID lockdowns, pre-geopolitical tension, pre-Taiwan, to make sure that the supply reliance was in China?
So China is one of the world's leading suppliers of API. The technology is there to do it. The scale is there to do it. And we are not at all alone in this. In fact, nearly all the APIs for anti-infectives are produced in China. So it's not an unusual situation at all.
Thank you. Is the profitability of Chinese pig farming more important for your business than the size of the pig herd?
Is the profitability more important? Yes, I think it is. Because without profitability, there is not the ability to pay us or the incentive to look after your pigs in the best way. So I think profitability is a bigger driver than pure numbers.
Can you refresh our understanding around competition? Are you losing sales to other products, and who are your major competitors?
Answer to the first question is no. We are continuing to progress on market share gain in all territories. Major competitors are a mix of the global players such as Elanco and others. And there are a number of regional local players that we compete with. But in general, we compete with the globally sized animal health pharmaceutical companies.
We've all seen bird flu has been in the news recently, particularly with rationing of eggs. Are you planning vaccine research against that disease?
We don't currently have an active project for avian influenza. It is a big challenge. It's probably beyond ECO to produce that. A working poultry influenza vaccine is kind of the ultimate goal here. There's many players, government funded, public body funded, and other players researching into this area. It's not an area that is easy for us to play in right now. So it is a threat to poultry production, but it's not an active research project. We don't want to be active in every single area of the animal health market. And we think that public bodies and better funded global organizations are more suited for avian influenza research right now.
Are there any special factors that have been responsible for the high sales growth rates of Avicen seen in Latin America and Southeast Asia regions? And can these growth rates be sustained over the longer term?
So what's driving our growth there is improved penetration into the market, and that is driven by Avicen's exquisite efficacy against the major challenging diseases. So that piece is absolutely sustainable. The growing areas, we're growing in where the poultry and the swine herd is either big or is growing or is professionalizing. And that trend also is consistent. We have to find a way to feed around about 10 billion people. And that often is solved by increased poultry production and increased swine production. So I think that demographic trend is also sustainable. So I think that the answer to the question is yes, that is sustainable in both those regions.
Thank you. You've given us a sense that you're comfortable hitting expectations, but can you offer any more detail on the momentum in the Chinese market in the past 2-3 months since the pork prices there have recovered to above 20 renminbi a kilo? Well,
I think Chris mentioned this, but I'll just re-emphasize we had a strong month in September, and following September, as noted in the report, we had a very strong October, and to date in November, that is continuing. So I think that over the last 3 months, if you include November, we see the market actually doing what we have said, which is it's recovering into profitability, and that is driving utilization and sales of Avicen. So I think over the last 3 months, that's the detail that I'd give. We're seeing consistently better performance in China as a consequence of the market recovery.
And this was mirrored by a statement that Genus put out last week, actually coincident with our interim statement release. They put out an AGM announcement and made similar comments about their China business.
Thank you. Can you comment on inventories edging up?
Yeah, so I mentioned this earlier on in the presentation. Largely, it's driven by China. We're overstocked in China, and this was a protective measure to cover that period of where we were not producing. The factories shut down, and so because China revenue fell below the level at which we protectively planned, clearly we're still carrying quite a bit of stock. To put any fears at ease, the stock itself has quite a long shelf life. It's a 2 to 3 year shelf life, depending on the markets in which we operate, and therefore, we don't need to worry about stock becoming out of date. So it's really about China. We've mentioned that the recent trading over the last few weeks has been strong. So we're looking forward to a period where that overstock is reduced down to normalized levels.
Thank you. And I guess the follow-up question then, when do you expect that stock to be drawn down?
Okay. So my current view is that we will get back to a position which is better by year end. Will that be absolutely back to what a normalized position would be? Not sure at this stage. And it very much depends upon the timing of that China recovery. And it also depends upon what happens beyond the end of March. I mean, this is a continuum. Life doesn't stop at the year end. And so because of the lead time of turning API, which of itself is quite a long process to make it into finished product, there's a forward plan. And so the timing of the offtake and the timing at which that API ends up on our balance sheet depends to a great extent on the demand for April and May, and that will drive the particular stock holding at the end of March.
Can you talk us through the benefits of the new manufacturing facility in China?
Well, it's more modern, which means it's more efficient. It's got a better environmental footprint. It is a nicer environment to operate for our staff. It meets all of the current and future regulatory standards as far as we can look to that. It gives us capacity. So for all of those reasons, modernness, efficiency, up-to-date, environmentally compliant, regulatory compliant, and capacity, I think those are 4 or 5 benefits that are really worthwhile having.
Was there any particular reason for the change of auditors?
Yes, we had been with BDO for 3 years. We came from a very small firm who had been the auditors to ECO for many years, really from the beginning of ECO, and so it was right to move to a larger firm. Any observer of ECO has seen the substantial changes in the accounting for the group over the 3 years that we've been with BDO. When we got to this year, we had a difficult audit. I think everybody will recognise that, and we felt that the time was right with a change of chairman in the audit committee to put the audit out to tender. The result of that was a desire to properly match ECO's requirements with the audit model for the firm that was providing the audit. And it was that mismatch really between ourselves and BDO which prompted and acted as the catalyst for change. We're very pleased with our appointment. We think Hayes McIntyre represent the new age of auditing. They're a challenger firm. The lockhold that the big 4 firms have had on the public company audit market is being released and being encouraged as well, because the regulators out there want to see some of these challenger firms coming into that PLC environment, and certainly the proposal we received from Hayes McIntyre was quite enticing. So So we're very pleased with the change. We look forward to our next audit, our first audit with Hayes McIntyre for the year end March 23.
Thank you. Some frustration perhaps at the share price at the all-time low. Can you offer some reassurance that there'll be well, perhaps what efforts can be made to help bolster the share price, of which I know we would consider ourselves to be one, but do you have any other plans over the next 6 to 12 months?
Well, I think continuing to deliver good numbers in line with our guidance and in line with market expectation will help to support that. I think doing what we say we're going to do will be helpful. In this environment, actually delivering a consistent set of numbers without surprises on the downside is very favourable, unlike some other companies. I think also I would say that our R&D pipeline, we're not getting a great deal of credit, if any credit, in the share price for. And as that begins to mature, and we can show evidence of that, as we've tried to show here, it's progressing forward, the R&D pipeline, both at the short, medium and long term. As that gets valued a little bit better in the marketplace, that will also support the share price. And I think the share price to a certain extent has been almost a warrant or a bond on the Chinese pork price, which has never really been fair, but that should be eroding now anyway. It's a smaller part of our revenue in this half. We've also shown that the Chinese pig price is favourable now and the market conditions are favourable. So I think that sort of overhang, an exaggerated overhang of China, should begin to erode. So those are three reasons that I think that the share price could see some, and I would hope it does, see some positive movement. On a day-to-day basis, there isn't a great deal that individuals or a company can do on a day-to-day basis, but over a longer period of time, we've got a good shareholder base. We've seen very little selling pressure or rotation out of that shareholder base from the institutions, one or two for individual reasons, but nothing organically substantive. And I think it wouldn't take a great deal of support in the marketplace for the share price to move, really quite nicely. That could come from both retail side, because our trading volumes are generally relatively small. So it doesn't take a lot of buying pressure in the marketplace to have a sort of proportionate increase. So, I'm clearly invested in this company. We're all invested in the value of ECO. And I think it is being penalised to a certain extent from market conditions at the moment. And I think as we deliver against those market conditions that are outside of our control, and that we are a good position to be in, people will always want good quality food. Pigs and poultry have strong demographic growth as the population does. I think all the signals are very, very positive, and nobody would be more pleased if we saw more value being placed in the market on our share price than the management team.
Thank you. In terms of species, how broad is the mRNA platform that's been acquired from Imperial?
It's veterinary species. So it's broad, is the short answer to that question. We have a focus on swine and poultry, so we will be focused on that. If there's applicability to elsewhere, we would give the other species applicability to other organisations, because we are going to focus and continue to focus ourselves on the poultry and swine market.
And a quick follow-up on the China factory. Is it wholly owned or part of the JV?
It's the JV, so it's part of the JV.
Lovely. Well, that is it from the questions for today. So thank you both for those comprehensive answers. Obviously, we share in your optimism for the future, and we look forward to a further update in 6 months' time.
Thank you for hosting, Hannah. Thank you very much, everybody, for attending.